Hello, I'm an agent from Mortgage Services. Nice to meet you, Jane and Drew. And I appreciate your cooperation in providing us all the financial documents to make our analysis more accurately. Our analysis will be going into 5 steps. First, I'm going to show you your net worth and cash flow statement so that you can get a picture of how your finance is. And then I'll show you the ratios, which are criteria to tell you how your financial status is in comparison with industry standards. Your net worth shows you have $358,000 of net worth, which is higher than the average of your age. In the cash flow statements, you have a 2675 deficit. In your age, this amount of deficit isn't huge, but still need to turn it into a surplus. Ratios. Based on ratios, I can suggest one you should stop or keep doing to strengthen your finance and reduce your debt load, keeping your standard of living. Emergency fund ratio, 2 months. Actually, it should cover 3 to 6 months. You need to reduce some expenses and prepare enough emergency funds. Entertainment expense can be reduced as a solution. Saving ratio, 4%. 10% of saving ratio is recommended, and your existing regular savings are only for retirement or unemployment. As it is recommended in emergency fund ratio, you can save the surplus money into the high interest saving accounts, which is more easily liquidated with less risk of loss. Debt ratio, 48%. At age 35, generally it would be the highest level of debt relative to your income, but by time, the ratio should be decreased as setting up other regular savings to pay off the debt. TDSR, 21%. It doesn't exceed industry's maximum 40%, so it's okay. This is the summary of your financial status. We will go deeper as continuing the presentation. Total debt, including the mortgage, is $34,000. Total debt, excluding the mortgage, is $49,000. Okay, let's move on to the next step, debt management.
Okay, I will show you the debt consolidation. So here, you can see the line to value, and this ratio will tell you how much equity you got and how much room you have to move. Here, equity in home, this value, this is the value you have in the home. Combine your current value at home and your mortgage debt. And next one is refinance penalties. Here, refinance, you have equity room amortization because you have only 3 years follow in your mortgage payment. Here, as you know, the CMHC, the maximum is 25 years. So here you have only 23 years. So next one, consolidate. So mean that you bring a number of debt in different places together to one place and you make only one payment. So if you increase monthly payment, the amortization period will decrease. But if you reduce the amount of payment you make, the mortgage payment will increase. And here we have the new mortgage payment is nearly 25 years. Moving on to next step.
I'm going to compare the old and new payment of debt consolidation. So this is the old payment, the interest you have to pay for your line of credit, and the old mortgage is $130,097. So moving along to the new payment, the total interest you have to pay is $147,000. 812. So you actually have to pay more interest of 17,720. So why consolidating if you have to pay more interest? So if you look at how we consolidate the debt again, you can see that you actually can save more than 5,000 per year. Now I'm gonna recommend you another method that you could consider, which is a fixed rate loan. So as you can see, these are the liabilities, and the reason why I'm listing these two is because they have a higher interest rate than the unsecured fixed loan. So the recommended approach is that you can actually get a 40,000 5-year 8% unsecured fixed loans. Now I'm gonna show you how much that you can save if using this method. So this is an old payment, so the total interest you had to pay is 18,217. If you decided to get the fixed rate loan, you will have a monthly payment of 808.57. The total interest you had to pay over the 5-year period is 8,514. So now you can tell that there is a big difference in the interest that we just calculated. And with this method, you can actually save an amount of 9,703.
And I'm gonna show you benefit and drawbacks of recommendations. First of all, debt consolidation loans typically allow only one payment later than many loans, reducing the risk of delayed payment every month. In the case of you, the amount of monthly payment through debt consolidation loans was reduced and the mortgage amortization period was increased from 23 years to 24.907 years. It leads to increase the amount of cash available for elsewhere. By having more cash available, lower emergency fund ratio and saving ratio can be increased to create healthier financial conditions. For drawbacks, since debt consolidation loan also requires collateral, it risks losing collateral if the repayment fails. In addition, combining multiple liability with a debt consolidation loan does not change the risk of debt because it still has one large liability, even if it sometimes saves money through decreasing interest rate or creates usefulness for cash. And clearly the main advantage of fixed rate loan is certainty. It can help you plan financially or maintain a certain standard of living. Also, in the case of you, the current interest rate is significantly higher than fixed rate loan, which will save much money. Lastly, even if interest rate rises steeply, fixed rate loan can keep rates relatively low for a certain period of time. For the drawbacks, there is a possibility that the loan will be a hindrance to your future choices, as it is fixed for a certain period of time. And contrary to its advantages, it does not benefit from falling interest rates. If a bank cut interest rates, it may miss the low repayment it can bring.
So we will give you some other options. Look at the emergency fund ratio, that's the true 22 months. So to manage the debt in the best way, you need to increase um, the emergency fund ratio up to at least 3 months. This means that you will reduce discretionary expense and increase personal saving to increase total liquid asset. So you will save annual amount of $7,263. This means that every month you should save an amount of $605 from cutting discretionary expenses such as gym membership, entertainment, vacations, restaurants, and so on because of COVID-19 situation. On the other hand, looking at the savings rate above is only for 24%. So another option that has you manage that well is to increase the saving rate up to 10%. That means you must increase your cash flow by reducing discretionary expenses by $10,715 per year. It means $893 per month. And it also results in the emergency fund ratio being greater than 3. Furthermore, you can also increase the RRSP saving by $1,800 um, per year because the limit annual saving of RRSP is $6,000. Then reducing discretionary expenses by $10,715. The last option you can choose is 5 years variable rate that is 2.9%. That's lower than closing fixed rate 3.1%. Because of COVID-19, the fixed rate is going down. So in the future, if you choose 5 years closing variable rate, the rate will be increased, but just slightly or even decreased because of economic recession. And after 5 years, you can change to fixed rate if the rate is increasing. It's just depending on economic situation. These are our recommends for your in the debt management. Thank you so much.